What is gross profit ratio in accountancy, or how you can use this ratio to analyze the companies, how the company is doing in comparison to previous year, with comparison to other companies, or whether you should go ahead and invest in this company. That's all we are going to cover in this video. Stay with me till end. Hi, this is Melad Akbary from Akbary Education. Welcome to your own channel. As I told you, today we are going to cover the gross profit ratio. The gross profit ratio, what is in this video? We are going to discuss the profitability ratios at the first stage, the gross profit ratio, how to increase the gross profit ratio, the formula, example, and here is a practice question. Let's go ahead. The profitability ratios. First of all, the profitability ratios are a class of financial metrics that are used to assess a business ability to generate earnings relative to its revenue, operating costs, balance sheet, shareholders' equity over time, or whatsoever. But overall, it is used to compare, to analyze, to understand how the company is generating their profit in comparison to another fixed item, which can be a balance sheet item, it can be revenue, it can be a specific expense, it can be operating costs, it can be shareholders' equity or whatsoever. But the only main point is, how is the company doing? How the company generates a profit? That's the point. And it has many items which we are going to create the videos soon. But let's go to gross profit ratio. What's gross profit ratio? The gross profit ratio is also called, remember the names, under many accounting standards which exist, many rules and regulations which exist. It can be called gross profit ratio, it can be called gross profit margin, it can be called gross margin ratio, or whatsoever you hear. But there are three common names. If you face them, just remember this is the same one. Is often shown as a gross profit as a percentage of net sales. It is shown as a gross profit of the company as a percentage of net sales. What's gross profit? Whenever you have sales in a company, there are certain costs that you will incur to generate that product or purchase that product that you would like to sell now. So that's called the cost of that product. That's called the cost of production or purchase or delivering that service, which is the cost of goods sold. Whenever you cut that cost of goods sold from the sales, you will reach to gross profit of the business, and that is something used for this ratio, for this margin analysis, which will be considered as a percentage of net sales. Why net sales? In most of the cases they are considering net sales, but it can be the sales directly. Net sales because you will have some discounts, you have some refunds, you will have some returns and these things. That's why they are going to find out the net sales, that they can compare the position of the company with the previous year or with another competitive. Suppose you are doing comparing a company of Apple with the Google, you're comparing another company, or you're comparing whether the Apple is doing well now or in year 2000, then you will go for the net sales. Gross profit is sales minus cost of goods sold. I already told you that's sales of the business. The cost of goods sold will be deducted and you will end up to the gross profit of the business. Shows the amount of profit made before deducting the selling, general and administrative costs, or overall the operating costs. What does it mean? When you deduct the cost of goods sold, you will end up to the gross profit, but you have not deducted any amount for the salaries, for the advertisement expense, for the rent, for the fixtures, and whatsoever repairing and these things, insurance and whatsoever you have paid. So these are the operating expenses which has not been paid, and the gross profit is the amount which is pending in the business that you can cover this one. You can cover the operating expenses. The ratio indicates the percentage of each dollar of revenue that the company retains as a gross profit. What does it mean? If it's come to like a ratio of suppose 20%, this 20% ratio indicates that the company have 20% of that revenue which was generated now to cover the expenses. Now, as a gross profit of the business, 20% of that dollar or that amount which was already generated as revenue has been put now as a gross profit. What does it mean here? It means that 80% of the revenue has gone in the cost of production, or in the cost of preparing, or in the cost of purchasing that product which is already sold. So going ahead, let's test your understanding for what we have covered. Review this question. If you cannot just find the answer, go back and check the video. Until now, you will find the answer. That's from the content of the video, this video. So insert your answer as a comment to this video. Going ahead, we have how to increase the gross margin ratio. Suppose you are accountant in a business and the board of director or the CEO of a company told you, we would like to enhance our gross profit margin position. How we can do that? You're an accountant, you're expert, you need to reply. Or there is another side, you have compared two companies. Suppose the American airline, you have compared with Pepsi, or Pepsi with Coca. Let's go for a better comparison. Pepsi and Coca-Cola, you have comparing them, and they have both gross profit ratio of 40%, and they have like net profit ratio of 10%, or whatever you have compared. But inside the gross profit, now you can see there is an action Coca-Cola is going to do that, and this will bring the cost of the business lower, the cost of production lower, and will increase the gross profit. What will be that thing? How it will affect on gross profit? This is something as an accountant, as an analyst, you will already know. But what are these things that can increase or vice versa decrease the gross profit margin? Let's go to that. Buying inventory at a cheaper price. If you purchase the inventory at a cheaper price, of course the cost of goods sold amount or total cost will decrease, and that will mean that higher amount is the remaining balance as a gross profit. The easy way. How it can be possible? You can go with the bulk purchase. You will receive a discount and there is a decrease in the cost of purchase. Or another term, if you remember, the Apple was doing most of the manufacturing inside USA, and now they transferred to a cheaper country, to China, or the same of that. There are certain geographical locations which the cost of products, cost of production is much lower. Then they can shift to that area to decrease the cost of inventory, or they can purchase the same product from China, Europe, USA with different prices. Where you should go that you can have a lower or cheaper cost of inventory but keeping the same quality of inventory. Other one, decrease the production cost, which I already told you. It can be by enhancing the production process, productivity and efficiency. It can be by bringing the AI and machinery and machine learning to the production process, and whatever possible, like unfortunately changing the human with the machine. This is a possible way to decrease the production cost. And the other way, which is almost impossible in current situation, increasing the selling price to a higher level. Like suppose you are selling it at 100 with the same cost, now you can sell it at $140 per unit with the same cost, which will increase the level of gross profit remaining after cost of goods sold. Going ahead, what's the formula? Gross profit ratio is sales minus cost of goods sold divided by sales. When you divide, what you will divide exactly is the sales minus cost of goods sold, which will end up to gross profit. Gross profit to the sales will give you the gross profit margin or gross profit ratio. Why we are using mostly the net sales, or what it is included for? Why? In some of the cases, some of the companies have many returns, too much discount and allowances, but some of the companies do not have, or in one year there is too much returns and in other year there is no return at all. But we need to reach to the point which exactly bring the sales to the net sales by just deducting the returns, allowances and discounts and these things from the original gross sales. That will be the net sales, which is used for the calculation of this ratio. Going ahead, there is the second test up to this level, you have watched the video till here, just review this question. If you are okay with that, go ahead and insert your comment answer as a comment below. But if you are not feeling well, just press the arrow key, go back, watch, and make yourself confident, and go ahead with the rest of video. There is an example. That's a simple income statement. You can see here we have sales of $1,000, cost of goods sold of 600, the gross profit of the company 1,000 minus 600 is 400. We have the SG&A operating expenses of 200. The operating profit is, which is called profit before interest and tax, because no interest and tax has been deducted, is $200. You can see the operating expense, which was the other name given is selling, general and administrative expense, or operating expense deducted, and we reached to PBIT. From that we deducted the interest expense, the PBT, or profit before taxes, there tax we deducted, and we reached to net profit of 125. Now, what is the gross profit? In simple word, when we deduct the 600 from 1,000, we reach to gross profit. And when we divide the 400 to 1,000, the answer will be 40%, which is 0.4 or 40 cents. What does it mean, this 40 cents? From each dollar of the revenue generated by the company, 60% of that, or 60 cents of that, gone to cover the cost of goods sold, the item purchased or produced. And the other 40% is the remaining as the gross profit to cover the operating expenses, taxes, and interest of the company, and a portion as the net income or loss of the company. That's it. There is a practice question, very easy one. Sales of the company was 10,000, cost of sales was 6,500. What's the gross profit percentage? Simple one. Sales minus cost of sales, which is 10,000 minus 6,500, end up to 3,500 as the name of gross profit. That gross profit divided by 10,000, 35%. Option A is the correct answer. Thank you so much for being with us till end of the video. Appreciate if you press that beautiful like button, as well as subscribe to the channel if you would like to see similar accountancy specialized and financial analyst videos in the future. Thanks and have a nice time.